Dr. Fetcher, can you please proceed with this evening's orientation?
Yes, Dr. Mowry. At this time, I'd ask Ms. Audrey Bear, financial advisor with Piper Sandler and Company, to review the proposed general obligation bond series 2025.
Hello, good evening, everyone. Thank you for having me. I have a couple of slides with just some information for the board. Please stop me if there's questions. It's good to be with you again. So we're here to talk about the potential financing related to the referendum that passed this year for the potential middle school project. This interest rate chart is just a reminder of where municipal bond rates have been and where they are now. We don't make projections. You'll see it end with current. We don't know where they're going. But you can see the COVID and immediately thereafter were the lowest rates in history. It doesn't matter how far back we go, that remains true. This page has a lot of numbers, so bear with me. The important part of this page is the column on the far right. This is all of Abington School District's existing debt service payments or debt. This includes the high school project and various other projects that have been completed. Each column is a bond issue. You see the year it was borrowed at the top, and each row is a payment, represents principal and interest. Principal once a year and interest twice for each one. Again, the key is the column on the far right. You see we have the $11 million figure, which is currently in the budget for this year and has been, for the last several years. They're all fixed rate. They are locked in, and if you do nothing, these payments will stay the same. These numbers are important. As you see, they stay in the $10 million range through the term already in your budget. This is a visual representation of the same numbers, and the important part here, you will see that the dark blue piece, the teal, each one represents a different bond issue, but when you see them all added together like this, it's just a visual representation that the numbers are level year over year in your budget the best we can do with our final payment in 2044. Potential middle school projects. Estimated based on the referendum vote at $285 million. We're just early estimates here on timelines and figures. We're too early in the process to have everything pinned down, but for estimate's sake and to start the discussions, we are looking at potentially 3 borrowings, $20 million, $135, and $130 in the coming years. The figures, again on here, I know it's a lot of numbers, difficult to see. The first column is those same figures you saw earlier with the annual payments locked in, fixed rate. Those are your do nothing, already fixed in and will not change. Potentially, and again, we're early in the process, we don't have final figures or timelines, potentially looking at borrowing $20 million this year. The 135 would be in 2026. And the final borrowing, again, potentially depending on construction bids and timelines, in 2028. When you add all of those things together with the payments we already have in place, you see on the far right some estimates of what the future cost might be, again, if the project was $285 million. We have our current $10.7 million this year already in the budget. And you see for the next several of years, there would be increases in your debt service line item in your budget until we phase in the budget impact for the potential project. Again, these are estimated current interest rates and current figures. They will be revised as we move through the process. Any questions so far? Okay. From the board? This next page is, again, an estimate, an illustration. You have the principal amount of $285 million, which was the referendum amount. So that's a not to exceed figure for the borrowing for this project. Costs of issuance, other deductions, capitalized interest, And in this scenario, you would have $270 million available to finance those projects. These numbers, again, will fluctuate as we get bids and move through the project. There are two types of bond issues. You have a competitive sale versus a negotiated sale. A competitive sale is an auction in a 15-minute pre-selected window, and a negotiated sale is a more fluid, flexible process, where you select your underwriter ahead of time, and just like it sounds, you negotiate with them on the timing, watch for market variations, select the best timing to lock in interest rates. As you can see there, there's some flexibility, and it is a more common method for bond issues in the United States today. Of course, with any decision, there's always pluses and minuses of each side. Competitive sale, you get competing underwriters, but it's in a predetermined 15-minute window, and we do not have flexibility. That has to happen on a scheduled board meeting date. It's negotiated, we have more flexibility with timing, we can plan ahead, pre-market, solicit interest in the bonds, and do the best job to lock in the best rates. We talk about retail investors. What this means is individuals. Might be an individual that lives in Abington School District, it might be an individual that lives somewhere else in the state or somewhere else in the country. But a retail investor would be a person, Grandma Smith, that wants to buy a bond for their investment portfolio. Anyone with a brokerage account can buy Abington bonds when the time comes. Municipal bonds are sold in $5,000 increments. So for an investment of $5,000 or any multiple thereof, any individual can purchase those bonds as an investment for their portfolio. For a Pennsylvania resident, they get a tax advantage on bonds from any municipal bond, not just Abington. We call it triple tax exempt, meaning the interest they earn is exempt from federal income tax and state income tax. So that's why a lot of individual investors do like municipal bonds. And you will see a lot of retail investors interested in those for tax advantages. And that was the explanation of the direct, which is your individuals versus someone maybe purchasing for a mutual fund or a stock account. I know that was a lot, very quick. Madam President, was there any questions or anything else you'd like me to give you more detail on?
Not from me. Any members of the board have questions?
Yeah, on slide 8, it mentions a project fund deposit of $270 million, and I know we're talking about 285 for the project. Well, is there a discrepancy there, or what's the reason for that difference?
Well, that's a great question. So $285 million is the principal amount or the amount of money that the district may borrow based on the referendum. It can be that number or anything smaller than that once we get through construction bids and we see what those costs come out to be. Now, if you look on here, there's some abbreviations. I can explain each one. The first line, it's abbreviated OID, OIP, and I know you can't read the footnote, so I'll read it for you. That is original issue discount or original issue premium. This is a factor of the market. We do not have control of this. When you have a bond sale and you sell bonds to investors, whether they're retail, institutional, it doesn't matter. They're not sold at face value. And again, it's a factor of the market. So when this estimation was put together, bonds were selling at a discount, meaning less than their face value. That's the $8.5 million deduction that you see there. Okay, so that's a factor of the market. So that number added together is the proceeds line. The cost of issuance, underwriter's discount, and insurance are estimates at this point. Each time you borrow money, we get quotes for the bond insurance. So that pricing will change each time. But for sake of an estimate, we had to start somewhere. So you see those numbers there. That's all the costs of doing business, of borrowing money. The capitalized interest line item is the one that's a little more complicated. So capitalized interest is money that is in your construction fund that you use to help make the first couple interest payments when you borrow money. You do not have to do this. It's a tool to phase in the budget impact. That is how we get to the budget impact being over 4 years instead of hitting maybe in 1 or 2 years. It helps with the phasing of the budget impact. So that is borrowed money that you use to make interest payments. So when you add all that together, we're down to 270 to spend on your projects. Now you also, depending on timing, you may have some interest earnings and some other numbers to add to that. But again, this is an early estimate. It will all change as we go through the process.
Thank you.
I do have a question now. I think I remember Mr. Lionetti saying something to this effect, and I think you were just referencing it, that when the bonds are issued, it comes to the district as a lump sum. Is that correct?
Yes.
Okay, and then that lump sum is deposited in an interest earning account?
Yes, so the project fund deposit, the line item at the bottom would be wired from the underwriter to a designated bank account that your business office will set up for the construction fund. Yes, and same rules as school code apply to how you can invest and earn interest on that.
Okay,
Same rules that you're used to with your other accounts.
okay. Can you, Ms. Denicola, do you mind are the rules complicated?
The rules are not complicated. What it does, the rules provide for protections for school districts. So for the dollars that we invest in banks, they provide us collateralization letters that protect our deposits over and above the FDIC insurance.
Okay, okay. And and the interest rate on those accounts is just determined?
Market-based rates.
Okay,
Market-based rates.
okay, all right.
Remember, we don't predict interest rates.
No, I understand. That's why I didn't ask you what they are.
No, you
was
put
just
her on the
curious.
spot instead. No, I'm teasing. No, we don't predict those, but it's the same as your other accounts.
Okay,
School code state limits you, no stock options or anything crazy.
right. Okay.
So you mentioned a few people in Pennsylvania that purchase Pennsylvania municipal bonds get tax advantages, and not to go into the weeds of that, but should a community member, or I guess someone that lives in Pennsylvania, be interested in, say, these bonds or any municipal bonds, who would you direct them to? Their financial planner? Like in this business, who is the person that would execute purchases for Grandma Smith or whoever it is that you're talking about?
Sure, great question. So anyone with a stock brokerage account can call their broker, or if they have an account that they manage themselves, they can purchase bonds through that account.
Okay.
Or use their stockbroker, financial planner, whichever proper term you use for your individual that handles your investment accounts could do that for you.
And it's not just this, but it's any municipal
Any
bond.
municipal bond, that's right. And like I mentioned, all municipal bonds, whether it's a school, a township, a county, even Commonwealth of PA, they're all sold in $5,000 increments. All municipal bonds, yes. And the tax advantage that I mentioned briefly, for the investor, they don't have to pay federal income tax on it, where if they have a corporate bond or a stock and they earn money, they owe taxes on that. So we call that triple tax exempt here in Pennsylvania for a Pennsylvania resident. So you do get some benefit for that as far as tax time. And that allows you as a school district to pay a little bit lower interest rate than a corporate bond. So someone purchasing a corporate bond, they still have to pay their taxes. So you can say, well, you buy a Microsoft bond, you owe taxes, but if you buy mine, you don't. So you get to pay a little bit lower interest rate with a municipal bond. It's an advantage for you as a school district.
But checks aren't written to the school district. It's through their broker or through their
Yes.
financial planner. It's
Yes.
nothing that the district hosts.
Correct. So you, as a school district, you never have your possession of the bonds. Essentially, the underwriter, when they wire you this money, they're purchasing all the bonds to be sold in those $5,000 increments. You don't do that yourself. That's part of the underwriter's service to do that for you.
Perfect. Thank you.
I have one for you, please. On slide 6, you are showing almost incremental amounts at different series years. Can you just explain what that means or why that we're seeing different amounts of the 285 total budget, and any context to just help understand that a little better, why it wouldn't be all at once, for example?
Sure. So these three, I'll call them three buckets of borrowing, are based on a preliminary draw schedule. And a draw schedule is something that your architects and engineers and contractors put together, and it's how much money they think invoices are going to be each month. So they give us a monthly number. And this is, again, a very early estimate, but based on those early draw schedules that we received a few months ago from ICS, the $20 million would last through December of 2026. Now, again, that may change. So then once we get into the later years and there's shovels in the ground and construction really happening and lots of contractors on site doing things, those bills will go higher each month. So the bigger number, of course, is in the middle when we're in the heat of construction. And again, this may change once we get started with things. It might be that the second piece is 100 million instead of 135, but those will be based on the construction needs.
Thank you.
I know these are projections, but even with the projection, when would the homeowner expect to start paying in taxes for the bonds?
After the first bond issue,
Okay.
after the first borrowing, the next budget.
But if you could clarify, that would be graduated over the time of all three of the bonds.
Yes. If you remember that capitalized interest number that I talked about, that is also part of this. One of the advantages of being able to, and again, it's based on your construction schedule, but one of the advantages of being able to borrow in three pieces instead of all at once is, in fact, that ability to space out the budget impact and therefore your taxes. Our intention is to spread those over the years between now and 2030. Again, based on these preliminary schedules.
And just to be clear, there is no impact from the first bond for the 2025-2026 budget year.
Correct. That money has not been borrowed yet.
Okay, so homeowners or property owners would only see the impact from the $20 million bond in the 2026-2027 budget year.
Yes.
Okay.
Yes.
Okay.
That is as we have it planned based on this draw schedule.
Okay. I just want to make sure that we're as clear as we can possibly be
Yes.
to
yes,
our
the
taxpayers.
intention, and again, we do have it labeled series of 2025. It would be borrowed in the 25-26 school year based on these draw schedules and payment needs. So borrowed during this school year, payments would start next school year. 26-27 is when your payments would start on that new borrowing.
Perfect. Thank you so much.
And same with the other two. It would be borrowed in 26. Payments would start the following school year.
Okay. Great. Any other questions?
And just to clarify, the reason why we're borrowing 3 times is, and correct me if I'm wrong, that we only have 3 years after the borrowing. So we have to spread out the borrowing to cover the length of the project. Is that correct?
That is a factor in it, yes.
Okay.
And again, we're trying to match the borrowing for how much money we need to spend in a certain time period. And there's several reasons we're doing that. One is we have to spend it within 3 years. The other one is we want to borrow the money when we need it. When we need it. We don't want to pay interest on it before we need it. And most importantly is that budget impact. We're trying to spread it out the best we can over the term of the construction.
Thank you.
Anyone else? No? Okay, Ms. Lee? Don't want to forget you. Okay. All right. Thank you very much.